All right, folks, we are very, very happy to have you back to the 49 North virtual meeting platform. And Happy New Year to everyone on this. I think it might be late on that, but I'll still throw out a Happy New Year. But at the end of the day, we are very, very excited to host today Osisko Mining Royalties and their CEO, Sandeep Singh. Great guy and even a better company. Sorry, Sandeep, on that, but we'll
it's fine in that order.
We'll work on that. Again, for you guys, at the end of the bottom of the barrel, you've got two options for Q&A. One is a voice audio direct Q&A. And then the one we very much recommend is the type in. This is one of the better companies we've had in front of you folks. So I really want you to understand the story and recommend any Q&A that's involved. If not, feedback's going to be a part of it. But with that, I'm going to throw it over to the great and the one and only Sandeep Singh to present this, because you guys need to understand the story.
Well, thanks for that, Matt. Appreciate the build up, and I think good afternoon to most of you. Happy New Year. I think it's still appropriate. I am Sandeep Singh, the President and CEO of Osisko Gold Royalties, and really happy to give you an intro, or in many cases an intro, but for some of you an update. I noticed some friends already on the line. Happy New Year, Paul, and others. So I'll walk you through it, but I'll try. It's always tough virtually when you don't know exactly who's on the other line. I'll try to thread that needle in terms of an introduction and an update. I think it's a reasonably easy story to tell, which is a good thing from a royalty company perspective. So I'll try to do it within about a half an hour and leave plenty of time for questions at that point. I will be making some forward-looking statements, so please be mindful of that. Maybe before I get into it, I think we're spending a couple minutes, that we could spend the whole hour on gold and what it looks like going forward, the outlook for it. I am, with all bias aside, quite bullish on the outlook for gold. I think the only thing that I might have misjudged, and many of us misjudged last year, was the strength of the US dollar. From a bounce back perspective, how quickly things did rebound. Second, maybe just from a relative strength perspective, often not a lot of things you can buy if you don't like the dollar. But that was clearly one of the surprises of last year. As we sit here today, I would say clearly, rates had to go up. That's not a surprise. Tapering first had to come into play. Eventually, the Fed was going to start decreasing their balance sheet again a little bit quicker than maybe some people expected, but clearly that had to happen as well. So I think some of that news obviously is now built in, but I look at it from a simpler perspective, because you have to kind of zoom out once in a while to make heads or tails of this. But ultimately, I don't think the Fed has that many tools at its disposal to do exactly what it's claiming it's going to do. Clearly, they'll raise rates, but at the end of the day, I don't think they can raise rates fast enough to overcome inflation. I think inflation is going to be a lot stickier than people expect, and I frankly don't think they want to. I don't think it's in their best interest to knock down wage inflation after decades of stationary real wages. I think if they do too much too soon, they'll end up hurting the economy. So I think it's a pretty fine line the Fed has to walk. And ultimately, I expect inflation to be running hotter than their target for longer. And I expect gold to have a pretty good run rate in that environment. Overall, when you look at S&P, still hitting pretty much close to its highs, most of last year, new highs every other day. I personally can't see a better time or a more important time to have a bit of your portfolio in something that's uncorrelated and something that's a bit more of a safe haven investment. And I think gold plays that role. I also think royalty companies within the gold sector play that role because we don't have the swings that a mining company necessarily would have from an OPEX and CAPEX investment perspective. So I think it's a good time for gold, and I think within gold as a royalty company will fare particularly well. We can come back to this at the end of the conversation. As I said, I think we can go down so many different rabbit holes when it comes to the outlook for gold, but I thought it was useful to spend a couple of minutes on it at the onset. Who are we at Osisko Gold Royalties? We are the 4th largest precious metal royalty company. We are the largest intermediate. There's a few seniors in our group that you probably will be familiar with. What does that mean to be an intermediate in the royalty sector, the precious metal royalty sector? Well, last year, that means we generated 80,000 ounces of GEOs. That is gold equivalent ounces, so mostly gold, but some silver also turned into gold for comparable purposes. So 80,000 GEOs or 80,000 ounces of gold, if you will, at a 97% cash margin. So a phenomenal business. We get to keep 97% of every dollar we sell those ounces at. So pretty phenomenal business. That is from currently 17 producing assets within a basket of 160 different royalties and streams. Not all of those are important, I would say to you. Some of those are option value type assets. Maybe one day they come good. But the point is, it's a very deep portfolio that has a lot of other assets that will be coming online almost every year now for the rest of the decade and for decades to come. We have a market cap of about $2 billion today, pay a significant dividend yield for our sector on the high end of our peer group at 1.5%. That's a dividend that we increased last year. We increased it the week after gold fell by about $100 an ounce in that week. And we did it intentionally. It was about a 10% increase to show the ability for this high margin business to continue to increase dividends, only ever increase dividends, no matter what volatility we're facing in the sector. And as soon as we did increase that dividend, we then followed that up by going out into the market through our NCIB and buying back 1% of our company. So last year, between our dividend at about 1.5% for the year and our buyback, we gave back shareholders 3% of the company essentially. And we'll continue to prioritize returns of capital to our shareholders as we've done for every year since our IPO 7 years ago. And we trade at the lowest multiple in our peer group at less than 1x NAV, less than certain mining companies trade at that have full CapEx and OpEx risk. And that's a gap that we intend on closing. We were one of the best performing royalty companies last year in step with the biggest in our sector. So we did do well on a relative basis. It was just a tough year all around. So winning on a relative basis in a down market is not as satisfying, but it was a win. But our underlying NAV, the strength of our asset base, kept up and outpaced that share price performance. So kept our multiple low, but that's something we're looking to bridge the gap on this year. So just a bit of a snapshot as to who we are: big, meaningful ounces, deep portfolio, trading at a pretty significant discount. I'll spend a little bit of time on the royalty model, just for those who maybe are less familiar with it. It's a very potent model. That 97% cash margin business stems from this model. So essentially, we will buy royalties or streams which are similar, essentially prepay for forward and usually life of mine streams of cash flow off of an individual mine. So helping to finance the mining sector, adding to the equity and the debt that they can raise by forward selling basically some of their ounces into the future. The benefits of that model for our shareholders are that it's a highly efficient and scalable business. We only have 25 people that run our $2 billion market cap company listed in Toronto and on the New York Stock Exchange. And that's all the people we need to continue to grow our business. At the end of the day, once we take on our exposure, all we have left to do is cash the checks. So most of our time is spent on new business development, finding new accretive deals to add to the portfolio, And with every deal we add, the portfolio gets better. We have a significant amount of asset and cash flow diversification. So if you're more familiar with, the type of companies that maybe 49 North will bring to you, mining companies, operators, developers, a mining company, a producer with a 2 billion market cap might have one, maybe two assets of significance that underpin that cash flow. We've got 17 today of different scale of importance and more coming all the time. So significant amount of diversification that makes us a less risky investment. As I mentioned earlier, we don't have CapEx requirements. We have very predictable operating costs contractually. So we know what we pay for every ounce of gold. It's either zero for a royalty or it's a very low number for a stream. And that's what leads to that margin I mentioned. We also don't have, I shouldn't say we don't have, we're insulated from geopolitical risks. Our deals are with the companies, not the countries they're in. And we're also, I'll show you later, we're also in safe mining jurisdictions. So we're as safe as you can get in the mining sector from a geopolitical risk perspective. Yet we have all the upside. We have all the leverage to gold. We have all the leverage to free ounces that our operators find over the life of an asset. So it's a really neat model that is lower risk, but still has a lot of upside to discovery and to gold price. So this is a little snapshot of our asset base. I'll go through individual assets later that I think are important to understand, but just this gives you a snapshot of our first 3 quarters. So in the first 3 quarters of the year, we did just over 60,000 ounces of geos again. So think of it as gold or silver and gold together. You'll notice that breakdown in this pie chart, as I mentioned, 75% roughly of that is gold. The remainder is all silver. Since this chart was created, we put out our Q4 numbers just from an overall production perspective. We didn't break them out by asset, which is why we haven't updated this chart. But we ended the year with 80,000 geos total, right smack dab in the middle of our production guidance for the year, which was a win for us. Happy with that result, especially given at the tail end of the year, it was obvious that some of the operators, not just our partners, but the sector as a whole, had to take their foot off the gas a little bit. I think, there's a lot more cases of Omicron around the world that's leading, the miners to deal with absenteeism, more quarantining. So just by virtue of that, it was obvious to us that people, weren't as efficient as we would have liked them to be. For us, that's no big deal. Any ounces that don't come off in one quarter come out the next, and we don't have the cost associated with any of those efficiencies. So it's really immaterial to us. But even with that backdrop, if you will, for the sector, really happy to end up where we did. And then, as I mentioned, we are a gold and silver company. We do have a little bit of other exposure, which is in the base metal space mainly. And we, like our peers, have said we would take on a little bit of other exposure in the right circumstances. We just haven't filled that category, which means we have maybe an easier chance of filling it in the future. And for us, that other exposure starts with battery metals, copper, nickel, general LME traded type metals, and then the interest wanes from there. But we are sticking to our core of being a precious metal company. I touched on it earlier. I waited to kind of go through it in more detail with the graphic, because I think the graphic is pretty telling. We are a global company. We've got assets all over, but we are an America's company by design, an America-centric portfolio and a very North American-centric portfolio at that. And that's where we feel the best. We've managed to create a portfolio with a good risk-reward basis. By sticking to that, we will look for assets in other places, and at times we will take on a little bit of incremental geopolitical risk if it comes with better counterparties, better upside, better deal metrics. But generally speaking, we're not looking to take on too much risk for our investors and ourselves. We think a low risk political portfolio always matters in the mining sector. I think, frankly, it'll only matter more and more. There's a lot of places in the world that we're adding to the list of no-go zones. And especially in a post-COVID world, there's a lot of countries that are struggling to fund themselves, to fund budgets, and mining is always a bit of a soft target. The reason I said, I'll reiterate it again, the reason I said we're as insulated as we can be is, one, our deals are with the companies. So they don't change. An individual country may at points in time try to take an extra pound of flesh from an operator through taxation or royalties, but that's between them and the operator. Our deals don't change, and we're not associated with any marginal cost production. We're not associated with any assets that teeter on the brink of profitability. So even if a country takes an extra pound of flesh within moderation, our assets that we're involved with are still very economic, so we don't suffer. And then on top of that, just by virtue of where our portfolio is, countries where the rule of law is firm, that adds extra protection to our shareholder base. I spent a little bit more time on that because I do think it's a massive advantage to our company. And when you maybe go back and you look at that contrast with it versus some of our peers, I think we stand out like a sore thumb. From an ESG perspective, again, this is a factor that we win on, and we will continue to win on. There's obviously more and more focus on this in our investor base, as there should be. You can't get to where we need to be, where we need to get to as a civilization without making some hard changes. So that's all good. They're never in a complete straight line, and sometimes you have to go in circles to get to the right results. But we do think the emphasis on this is good. Sometimes the manner in which rating agencies and whatnot are making us jump through hoops is not the most efficient, but we think we're headed to the right place. Nonetheless, we win on this metric. We win on it because we're partnered with some of the best operators in the business that take ESG to heart. We're in only tier 1 or mostly tier 1 jurisdictions where, as I said, environmental responsibility matters. You can't do anything unless you're tackling the environment properly. Workers' rights matter, community rights matter, governance matters. So our portfolio is a poster child for ESG. And then we've done some things to go above and beyond that to make sure that we continue to win on this metric. So I think this is something that, as more emphasis is put on it, our company will continue to reflect quite positively. I touched on this a little bit earlier, but it's worth reemphasizing that strength of partnerships. I'm sure you'll recognize some of these logos on the left-hand side. Some of the best in breed in the sector. Importantly, we're partnered with them on assets that matter to them. They're core to their business. They're spending time, energy, and most importantly, money on those assets. And as they do, our underlying royalties and streams get better, and they get better for free. That is one of the important facets of the royalty sector. And one of the reasons why our larger peers who have been more established for longer trade at the types of multiples they do, that there's always something in the portfolio that you bought and paid for a long time ago that's getting better. There's a new hole into something that no one gave you any credit for that changes the story and makes it better. We've been around now for 7 years, and we went from having 1 producing asset, 5 assets total, to now having 17 producing assets, 160 assets total. So throughout that time, you can imagine we were beavering quite hard to build a portfolio. Still are, always will be, but one from scratch, basically. And as we were, every time we added a new asset, we were paying for some negotiated version of what that asset was at that point in time. And it's only with the passage of time, which in mining you have to count in years, and more drilling, more work, those assets get better. And we're now at a point, we showed numbers until 2020 where we had 4 years in a row of 1 million meters drilled on our ground. That's 3 million feet, which is an absurd number to try to get into context, but it's more than Newmont would drill in their entire portfolio in any year. So we're getting a massive amount of work done on our ground. We've already made our bets, so any new ounce that's found, we get for free to our account, and we're seeing the benefits of that play out on our largest assets, but all the way down to our smallest assets. So this is a function of the company that we are in now, kind of our life cycle, a more mature company that we're benefiting from really the first time in our history, and we're benefiting from it in pretty significant ways that I'll talk you through in a few short slides. From a balance sheet perspective, which is another important aspect to understand when you're thinking about a royalty company, we are a finance company. We finance the sector, so we sure as hell better have access to cheap capital to do that. We do. We have a strong balance sheet. I'm looking at this column here for Osisko Gold Royalties, and I'll give you a little bit of nuance, which is important here. We have, as of last quarter, we had $80 million Canadian of cash. We had investments in other equities totaling $660 million. Someone ringing the doorbell here. And we did have some debt, largely a convert that comes due at the end of this year, but we also had a largely undrawn credit facility at about 2.5% coupon, which we can use for growth. So all the capital we need to grow our business. The reason I said there was a bit of a nuance is we do consolidate financials with one of our sister companies right now. This is a development company that we spun out a year ago, give or take. And until our ownership drops below 50%, give or take, right now we own 75% of it. We'll be consolidating financials with them, but that's one of our core priorities this year, is to finish that exercise and send them out into the world in a more sustainable way. We're also covered by pretty much everybody that covers the mining sector with a very constructive view. So a strong capital markets presence overall. I touched on this again. I think hopefully the graphic is important. We've been paying a dividend, as I move my face again, a dividend from day one. From the first day we IPO'd in 2014, we've paid a dividend. It's only ever gone up. It will only ever go up. As I mentioned, we increased it in the middle of 2021 by 10%. Cumulatively, but at the end of the year, we'll have given away, or we gave away, we returned $184 million back to shareholders. We've also been active on our buybacks over the years, totaling $107 million to buybacks when the stock just got really cheap. And we'll continue to find that balance between a growing dividend and taking advantage of dislocations in the market, overreactions in the market to buy back cheap stocks.
So let me ask you this real quick. It's interesting to me. So the relationship, going back a little bit with Rosen, can you extrapolate on that?
Sure, I can. Let me just see where I am slide-wise. Yeah, maybe I'll switch slides so you can read this while I do that. Again, and it's always challenging not knowing who knows the history, who doesn't. But Matt is referring to our founder, a guy by the name of Sean Rosen. If you don't know the Osisko story, most people do, but assuming you may not, Osisko One, if you will, was a group of 3 founders, including Sean Rosen, that found, financed, permitted, built, and then sold the Canadian Malartic mine, which is Canada's largest gold mine, generates about 700,000 ounces of gold a year, and it's run by Agnico Eagle and Yamana. It's split 50-50 between them. In 2014, Goldcorp, which was the biggest, baddest gold company at the time, launched a hostile on that company. And I was actually an advisor there at the time. We sold that to Agnico and Yamana, and we spun out Osisko royalties. So we spun out essentially a 5% royalty on that flagship asset. That royalty is now our flagship asset, amongst others. And we started out life as a royalty company 7 years ago, give or take.
Okay.
And then building up this portfolio. Sean is still our chairman. He, as I mentioned, he's the founder of the group. He's gone on to also be the CEO of that development company we spun out. And in 2 years ago, just before COVID, I stepped in as president of the company as part of some succession planning. And then in that same winter, I took over the CEO mantle from Sean as he transitioned over to that development company. And
where's he now?
He is still Montreal based, if that's what you mean, but his primary responsibility is running the Osisko Development Corp, which has a 6 million ounce deposit in British Columbia. And he's still the chairman of Osisko Royalties, amongst some other things.
So in with what we're looking at right now, which is great and amazing, and with this company, is a spin out. And at the end of the day, it's young people that are involved with it, right? Am I looking at it right or not?
Yeah, well, yes and no. I mean, that spin out happened 7 years ago, so we're not so fresh from that perspective. But I will say it's a much more mature royalty company. I mean, that was a single asset company trying to fight its way.
So on that, who would be, looking at a comp? Who would be a comp, Sandeep, with you guys right now? Okay,
So
go back to this, and let's do that, and let's look at it. And so, who's the comp?
Sure. Look, I would say it's an interesting question because I'd say we kind of stand out relatively alone in some respects. So the biggest three in our sector are Franco-Nevada and Wheaton Precious Metals. They're phenomenal companies in their own right.
Right. And then they're already done. But so, like right now, where are you guys on the upside? And you guys are a $1 billion company, Canadian, right now. So what can we do in terms of these investors? And this is what I'm trying to do with you guys, is give them the op. And if you're a different situation, Franco is Franco. We all know that. Okay. So, but
why don't you give me a couple minutes, Matt? And I think in a couple minutes I can paint that picture for you, if you don't mind. So the reason why I think we're an opportunity you should look at and pay attention to is because I do think we stand out in a pretty unique position. We've got three large companies in our space, the big three, if you will, who have been around longer, have mature portfolios, really good companies, trading at 2x NAV. But I think we're in a position where those companies are finding it harder and harder to keep showing growth. And that's kind of what Matt was just pointing at. They've got portfolios and market caps that are so big that to move the needle for them, frankly, just to stand still, they need to do billions of dollars of transactions a year just to stand still. And the truth is, in this point of the cycle, that's hard to do. And I think when you look at their body of work in the last 2 years, you'll see, if you track it, that it has been quite hard for them to do. They've had to compromise in a lot of different ways. Then you have us as the largest, most liquid, deepest intermediate, good sized company, significant production from a lot of different low risk sources, with a diversified asset base and a low multiple, but with a lot of growth. So a company our size, are as liquid as we are, that fits, pays a dividend, ticks a lot of boxes, that I will walk you through the next part of this presentation, that can grow at a double-digit CAGR growth rate for the rest of this decade, really, that has the assets that have already been bought and paid for at a $1,200 to $1,300 gold price environment, to double production without spending a dollar, maybe not over the next 5 years, but over the next 6 to 7 years. That's a massive amount of growth for a company our size.
Yeah, it's amazing.
So that's the opportunity, is you get, we're trading in line with our peers, or even on the lower end on an EV to EBITDA basis right now, we're trading at the lowest end, but we have the best growth profile in the entire sector. And so when you factor that all in, we're one of the better asset bases. I would say an asset base that matters in the sector, that if you tried to replicate, you would end up paying a multiple of our market cap to do it, if you could do it, which I don't think you can. And growth that's coming on that's been paid for at the bottom of the market. So we're in a unique position where we have size, scale, liquidity relative to some of our smaller peers. And we have the growth that our larger peers won't be able to replicate. So I think that's the opportunity, Matt, if that's what you were driving at.
Yeah, and that's all I was going after.
Appreciate that. And maybe I think it's worthwhile for me to give you some components of that growth, because I think from a catalyst perspective, that's important. And I realize I'm already at that halfway mark. So I'll try to do this relatively quickly, but I think it is important to understand, and I won't be able to go through it all, because one of the challenges for me is there's so many assets where so many good things are happening that it's impossible, even in a 60-minute session, to go through it. If you're interested in more color, we put out a press release on Monday, which gave you kind of a state of the union of the things that are happening catalyst-wise that are important for us. And Hopefully that's a easy read if you want to go through it in more detail, but I'll pick on a few things that are important, starting with the fact that three of our most valuable producing assets are getting better right now, and significantly better. And I don't know of any other company that can say that in the mining sector, starting with Canadian Malartic. So this is our flagship, where we get 5% of the ounces from the open pit that is currently operating. And that alone is the most valuable gold royalty in the entire sector. It basically doubled in value last year, where the operators made the decision to build the underground. So the open pit is this beige color. The underground is this plethora of colors underneath it. So they're spending $1.3 billion US to build the underground. It costs us nothing. What it does do for us is it doubles our mine life, where the open pit was ending at the end of this decade. The underground has now pushed it to the end of 2039. So we have a flagship asset, which is good for 2 decades, and it's getting stronger all the time. Currently, that mine life is based on only half of these underground resources. As they go underground and infill drill, they've said they'll be able to extend the mine life even further. They're now drilling 1.5 kilometers away, and they're finding the same type of mineralization, so that will extend the mine life further. They found an offset zone that has a few pierce points in it here on the bottom left. If that hangs together, we're talking adding ounces in millions of bunches of millions. So this is a phenomenal story. It's a camp that they can keep mining on for decades. And at some point, and this is not my commentary, this is theirs, at some point you just have too much gold to keep extending your mine life. And what you do is you sink additional underground infrastructure into it, basically another shaft, and you start feeding your mill faster. The reason you can do that is when they transition from an open pit to an underground, the mill will only be at 1/3 capacity. So this, again, I'm rushing through this, and maybe I'm going through it a little bit too quickly, but all I would say is this is a phenomenal asset that has continued ability to give us catalyst this year. And this is the prize jewel in the entire royalty space. As I said earlier, one of the things that differentiates us from our peers is this is an asset that would be the top asset in any of the biggest companies in our sector. It sits in the body of an intermediate. And whilst it's massively important, it's by no means our only asset. This year, 2021, this made up 35,000 of our 80,000 ounces. So there's a lot of other acts in our company that matter, but this one on a bad day can alone justify our enterprise value. So it's an important asset for us. It's an important asset in the sector.
And just a couple of quick questions from the audience.
Yes.
Would these other companies agree with your analysis, or what would they say with these multiples? With all this great news, why has the stock not performed better, and why is it not validated as your royalty competitors?
It's a good question.
So those are the first two. So I'll leave you with that, and then I'll go with the other two.
Sure. And I see those questions now, so I'll try to keep an eye on that, but prompting me is helpful. So I think that was Malcolm's question. Yeah. Would they agree? Look, this slide is not my view. This is a compilation of the good news for you, and that question is the royalty sector is pretty widely covered. As I mentioned, we're covered by 15 analysts. The same is true of probably most people on this slide. So
who are you covered by? Just from me, who are you guys? Anything US or no?
We're covered by most people that focus on the mining sector. I had that slide up earlier. There's 15 analysts who cover us. We are covered by excuse me, US firms, but typically they're Canadian covers. So Bank of America, Merrill Lynch covers us amongst some others, but we are well covered. We've got coverage from Stifel, Nicholas, et cetera. So what I would say to you is these are street consensus numbers. So the aggregate of all the external views that are out there on the company. We actually think when we look at our own company behind closed doors, we trade at a lower multiple than this because our view of our value is higher. But that's the answer to your first question. I think the more important question is why the gap and how do you resolve it? So what I'd say is, last year, as I mentioned, we did beat the group. We just beat it in a down market, which is not not as satisfying. So we were one of the better performing kind of 1 and 1A with one of our bigger competitors last year. The underlying NAV just grew faster. I think the issue we had last year and why we weren't able to bridge this gap as much as I would have liked, despite the fact that we had a lot of positive things happen in the portfolio and through our company, is there just wasn't any money for the gold market last year. It was, after 16 years of doing this, which is a reasonable amount of context, it was just the worst level of apathy that I've ever seen for the gold sector. Everyone went into every possible other sector you can go to, including in other commodities and mining, but everything but gold. There was no need for safe haven investments because there was just so much money to be made in everything else. So that was the backdrop we lived in. There was no money for the gold sector. I think whenever that's changed, even when we had little blips in time over the course of 2021, we outperformed. We went and we closed the gap, and we did quite well. Sadly, though, in 2021, those gaps were pretty short-lived.
Sandeep, when was the last financing?
The last financing we did was in March or very early April of 2020. It was in the midst of the COVID crisis. So we raised
in 2020.
Yeah, we raised $80 million with a company, an entity called Investissement Québec, which is an arm of the Quebec government. So one shareholder came in and invested $80 million at a premium to market. And we did that because at the time, most of our mines were shut down. COVID had just hit in Quebec in particular.
Yeah, everyone scrambling,
Correct. Yeah, mines were shut down. We didn't know how long that was going to be. We felt buffering the balance sheet and giving ourselves a little bit of strength from that perspective made us look better, made us stronger, and frankly gave our shareholders a bit of peace of mind. So we stepped out, and we thought at the time getting a premium investment from one strong group was the right thing to do.
For you guys, any comps on that, like in terms of companies?
I'm not sure what you mean, Matt.
Like any royalty companies that were doing deals and getting financing at that time.
Yeah, look, I don't think you can comp that. I mean, the point is, I think as a royalty company, you always want a strong balance sheet. So that's a given. We raised at that time, others raised later. I think the point is everyone did what made sense for them in relation to balance. I mean, look, capital allocation for us is job one. It's job 1, 2, and 3. That's what we do. And so we always are looking to find that balance between a strong balance sheet so we can deploy capital, dividends, buybacks, et cetera.
Okay.
Why don't I just focus on these questions for a second, because I do want to make sure I catch the audience's questions. Hopefully, Malcolm, I caught your first one and started to touch on the second part of your question. But I do think with the catalyst, Malcolm, to finish that we have in front of us that are unfolding as we speak, that growth that I mentioned, the strength of our portfolio, the difficulty to replicate it, I do think we'll be able to close that gap. A little bit of that depends on a positive backdrop, which is true of not just us, but the entire sector. But I also, for the reasons we started talking at the onset, I do believe we'll get that positive backdrop. But for us right now, irrespective of what the gold price is doing a little bit or what the sector is doing, we make more money than we ever have. We have more assets and more ounces coming on every year. So that will continue to be true as long as the gold price doesn't completely crater. And that bodes well for us and for shareholders.
Which I don't think it's going to do. And
I don't think so either.
I don't think so.
Let me see. So two quick. I don't know if anyone
address Mark Andrews or.
I will. Yes, and I don't know if people can see others' questions, so I'll just read it out before I do.
Yeah.
Two quick questions.
I can read it for you if you want.
I can read that. Okay, thank you. Two quick questions, likely for end of presentation. What is the origin derivation of the company's name? It's an interesting one. And are there any countries that you just wouldn't even look at an asset in regardless of its value? So Osisko is a funny one. If you can, give me 60 seconds. Some would argue it doesn't mean anything, but it's just been around so much that the brand value is quite high, at least in mining circles. Everyone knows what an Osisko is. I'm remember, early days of when it came out. I think, I heard a number of different, rationales for it, including that it meant muskrat in native, in Cree. But I never actually gotten to the bottom of it. But it's been around so long, it's synonymous with our group and synonymous with mining in Canada that it's kind of made up a definition of its own, I think, over time. But sadly, there is no good answer to that. And there absolutely are. And if you know Osisko and if you know that brand, then you know that we are Canadian specialists, North American specialists. That's where the group cut its teeth. The founders made their big wins. And that part of our DNA is just not changing. So there absolutely are countries that are off our list from an ESG perspective, from a risk perspective, from a I want to sleep soundly at night perspective, and from a perspective that's what our shareholders expect of us. And so we can take on a little bit of extra risk, but it's in moderation, and it's only because other things will counteract for it. But because of our current assets, because of those growth assets I mentioned earlier, not a function of the company that's changing anytime soon.
Well, I'll say this real quick in just in conclusion, it is a great company and a great story, great presentation by you, Sandy. And can I call you Sandy, by the way?
Sure. Aussies do all the time. I've never been able to say my name to an Australian who doesn't come back calling me Sandy. But
I'm not Aussie, but I'll call you Sandy anyway. But at the end of the day, a great story. One of the best that we've had for this group on the West Coast, and really, really, really good story. I've been in the business for 20 plus years and knowing it. And so this is something that, jump in. It's a good one. And Sandy, thanks for your time today, and a great job, of course. And can't wait to work with you guys again moving forward.
Yeah, look, our pleasure. And again, thanks for taking the time to listen. I'll try to answer. I think Mark Andrew has one last question. I'll try to answer it. But before I do, I will just say, this is always tough to do virtually. It's tough to look at a little peephole and give these presentations. I look forward to the time where we can be traveling again. We had a little window and then it shut firmly on us again. But hopefully in the near term, we'll be able to do these things back to kind of normal roadshows when you can look across the table at someone and have a dialogue as opposed to this one-way conversation, which is a bit choppy.
Absolutely. And with that, with Mark or Malcolm or whoever it might be, we're going to continue the dialogue with you guys on this. So appreciate it, and thanks for your time. And Mark, Malcolm, everyone else, thank you for joining us, and we're good.
Perfect. Well, look, appreciate your time. And if there are any follow-up questions that I didn't get to, feel free to reach out either through Matt or Matt. You can share our contacts directly. Some of you know where to find me already. But thanks for taking the time. And I would say I'll just conclude with saying it's an exciting time to be us. I think we're gonna unlock a lot of value. The portfolio is only getting stronger. Mark, to finish with your question, because I think it puts a pin in everything. Frankly, nothing we care about is falling off a cliff anytime soon. Those assets underpinning the 80,000 ounces are there for the duration. They're long life. They're only getting longer. To it, we're adding some of the best assets in the sector. And with each asset, we become a better company, a safer company, a more diversified company. and we're a pretty clever, we think, pretty aggressive, certainly team. We think we'll be able to add some more inorganic growth to that as well, which people will care about. So appreciate your time. Hope your portfolios are off to a decent start, albeit in a volatile couple of weeks, but all the best, and hopefully we can catch up again soon.
Same to you.
Thanks.
Great job today.
Thank you so much. Take care, everyone.
Okay, great job.